A trade war mean for investors? And just how risky is financial incest? Or more politely, what do all these circular deals around the AI industry involving OpenAI, Nvidia, AMD, CoreWeave really mean for investors in a risk versus reward sense? What do Tesla's upcoming earnings mean for investors? And finally, what sort of stocks should you have on your radar or maybe off your radar, as the case may be? I'm James Early, and I'm here hoping my Wi-Fi holds in this rural Oregon hotel room. I am joined by my longtime pal, platonic pal, Simon Erickson, founder of Seven Investing. That's numeral seven, investing.com. And we're going to help you unpack these stories on this fourth edition of Curia's Investment Show. Simon, thanks for joining me.
Glad to be here once again, James. And you're on the other coast, normally the East Coast. Now you're on the West Coast, and I'm splitting the difference in Houston. We got this whole country covered, man.
So true. I'm in Southwest Oregon. It's kind of logging and winery country, two very different things, but it's a beautiful spot. And Simon, the market has been really hot in the U.S., as probably everyone watching knows. So I just like to start with a random fact. You can't go too wrong with random facts, at least in my book. This is from Market Sentiment Research. It says here, 40%, I'm reading here off my laptop just below the camera, that's why I'm looking down, 40% of the top 50 companies in the S&P 500 will undergo a 50% drawdown over the next 10 years. And people watching me just say, yeah. But it's true. It just underscores the nature of investing. Not just is investing a pursuit where a few stocks tend to carry most or all of the load. Even those few stocks, Simon, tend to have massive drawdowns on their way to becoming big winners. So it's just truly a game for the patient. I don't know if you have any comments on that as well. It seems like something you'd connect with also, especially given the focus of your investing at Seven Investing.
I think so, James. And just added some additional context too. We're coming up on Halloween, and it feels like we're getting spooked by a lot of things out there. Even though the market is hitting new all-time highs, investors are making a ton of money right now. The American Index of Individual Investors reported that only 33% of individual investors are bullish about the stock market during the next 6 months. And of course, the CNN Fear and Greed Index has now reverted back to the dreaded extreme fear quadrant once again. James, market is doing great, but people don't feel so good out there about it.
It's so weird, right? Just like the economy, Simon. Unemployment has gone up, but it's still been like broadly very low for the last couple of years. But everyone's so bearish. Yeah. It's kind of weird, right? We have this vibe session, to quote, I think it's Kyla Scanlon, going on forever, right? But it's not. It's just a vibe session. It's not really hitting the real economy. And same thing with stock market. People are so scared, but they keep buying stocks too.
Well, it's an interesting time for sure. I think that there's pockets of the market that are way overvalued and overheated right now, but then there's also pockets of opportunity that are being left for dead. So looking forward to talking about both of those here coming up.
I think that's a great point. Let me just derail us for a second on that, just maybe 30 seconds, not literally a second. Just like with stocks, where we have a small number of stocks that are disproportionately carrying the load, not just historically, but right now in the U.S. stock market, there are a small number of stocks that are contributing a large part of the gains. And a lot of that is connected to AI. In the U.S. economy, it's a small number of wealthy people, the top 10% of income people, that are disproportionately creating this spending. So that's a case where you can look at an average, but it's a misleading number. And we've had this example on the show before, right? You have a bunch of preschoolers in a room with a bunch of 7'5" basketball players, right? The average tells you something, but you wouldn't really understand what it really looks like until you went into the actual room. Oh, I see what's going on. It's the same thing with stocks. It's the same thing with the economy. I think our economy is propped up by a small number of wealthy spenders, and thank God they're out there spending. But without that, there actually is a pretty good bearish argument if you take out those wealthy spenders in the economy, and if you take out those small number of high-flying big tech stocks in the stock market.
Have you seen preschoolers lately, though, James? I mean, some of them are getting pretty tall. Just saying.
Maybe the average height. I know I don't know. I know this in Japan. I don't know about the U.S. The average height of the average Japanese person has grown 9 or 10 inches since 1950.
There you go.
Right? We got more protein, we got more vitamins, we got more, I mean, we got more bad stuff in the diet too. So yes, we are getting bigger. So that was a tangent on a tangent on a tangent, but bringing us back to what we're going to talk about first here is the China-U.S. trade war. And this has really been an ongoing spat for the longest time. CAN has been kicked down the road multiple times. November 10th, for example, is a date of expiration of some of the last deals that were set, 3 or 4 months ago. The topic du jour, and let me just frame this, by the way, if you're coming into this looking for some basics, the U.S. buys roughly $585 billion a year of stuff from China. China buys roughly $140 billion of stuff per year from the U.S. And by the way, that imbalance, is not inherently bad. I just paid a couple $100 for this hotel room last night, let's say. I don't expect the hotel to buy a couple $100 of stuff from me, right? That would be weird. So there's nothing. Unbalanced trade does not mean unfair trade. Of all that money, only $100 to $200 million of that is imports of rare earths from China. That's like almost microscopic, yet it is all over the news. Rare earths are super important in some super important industries like defense, like semiconductors, like EVs. China has about 70% of the rare earth mining output in the world, 90% of rare earth processing capacity, and 93% of rare earth magnet processing capacity. And just for a random factoid, let me see if I can actually share this. Our analyst, Xiaoping, put together some data here. Okay, window. So this is low tech here, but yeah, an F-35 fighter jet uses about 920 pounds of rare earth metal. So, that's a pretty powerful fact. So these rare earths, they're in a lot of stuff. They're in a lot of critical stuff. China now has a upcoming rule saying any product containing more than 0.1% by content of rare earths has to go through export controls. It is not forbidden to be exported. Important distinction, but it must go through these export controls. So they are tightening this. Trump responded with threats of 100% tariffs kicking in next month. That's the second time he's threatened 100% tariffs on Chinese goods. He did chicken out the first time. U.S. China trade, incidentally, is down 30% since July. In prepping for this story, and by the way, I've done U.S. China business for more than 10 years, so I'm pretty familiar with the trade relationship in general. There's a lot of talk going back and forth about this, but I think it really comes down to one thing. China is trying to call Trump's bluff. Trump really measures his success by the stock market. He critiques presidents of the past by how the stock market responded to their rule, and he loves to brag about the stock market going up under his tenure. And I think they're betting very simply that Trump won't take the pain for very long. This is China doing the taco trade on Donald Trump. And it's not just me with this view. I'm going to try to share one more thing on my screen here. This is the prediction live view of the poly market 100% tariff. This is the Trump end of the trade war on China in effect by November 1st, as Trump threatens. Currently, what is it? 7% chance right now. 7% chance the market is saying of Trump not chickening out, basically. A 7% chance of these 100% tariffs actually taking effect. That's pretty low. Trump and Xi are set to meet in South Korea at the APEC summit at the end of October. And I think that's not coincidental in the sense of this is why China has used this for the timing. They're basically testing their muscle. They're testing Trump's willingness to follow through with this or not. I side with the 93%. I don't think Trump wants to see the U.S. take pain. China takes the pain a lot better than the U.S. does. In terms of what this means for investors, though, I think there's a couple of points here. Maybe thinking very locally. First of all, if the trade war continues, if the 7% of bettors or capital betting is actually correct, there are no winners in a trade war, in my view. So I think there's a reason to look outside the U.S., outside of China, to Europe, to Latin America, to Japan, to some other country stocks, because that trade war is going to be very deleterious to both the U.S. and to China. If the 93% of bettors are correct, I think there are a few pretty clear themes. One is industrialization of the U.S. We're reindustrialization. We're definitely seeing that. Another one might be these companies like U.S. Steel or MP Materials, which is a rare earth company that the U.S. is partly nationalizing. I think it owns, off the top of my head, 12% now. The Department of Defense bought 12% of this MP Materials. This is a rare earth company that was kind of this random wacko little company for a long time, right? Because who in the US could mine rare earths? We gave that industry to China years ago. It's destructive. It's terrible for the environment. You know, the developed countries didn't want a part of it, and China was happy to take that up. Now we want that again. And so these companies are getting not just investment, but I bet they're going to get favorable policies from the US government. I don't think anything bad is going to happen to any company the US government is taking a meaningful stake in, at least over the next 3.5 years. So that's my monologue, Simon, on this. I don't know if you have any thoughts or critiques or any views yourself on this US China deal. I think it's probably a nothing burger for now. I think it's probably a nothing burger. It's probably going to blow up. She may have a slight upper hand, but he also doesn't want to crater his economy. He's also at a relative weak spot in his negotiations. So I think both of these guys are probably going to back down.
Yeah, James, for anybody who likes board games or strategy games, you remember how important it was to control Australia if you were playing Risk, right? Or, the different resources you would have if you're playing Civilization. It's like, this is why you see MP Materials up 500% in 2025. This is a spike due to a negotiation that certainly these assets, if you own them and the U.S. needs them domestically, it's going to matter. You know more about U.S. China relationships than anyone that I know, especially when it comes to investing. Back to your comment about it being a nothing burger, James. I mean, is there implications of this 5 or 10 years out, or is this just going to be some negotiation noise that might last for a couple of years? But for investors that are thinking for longer the period and the time of that, does this matter at all?
Yeah, Simon, that's an excellent question. And I think that's probably the only thing or the most likely thing to matter. In other words, if the 93% of bettors on play market are right, it is a nothing burger in the near term. But if you notice something, if you look back over the headlines for stuff like this or the past couple of years, it's been a recurring theme. China is unhappy. China is agitating for change. China is sort of saber rattling economically. They think they deserve a bigger place in the world economy, on the world stage. So no, this is not going away. This particular thing may be going away. This particular deal may be resolved. But the angst that China feels at being the number 2 economy, at not being such a pillar, when they believe on a purchasing power basis, they are the world's largest economy. That's not going away. And it's not just economic, it's political also. We see this in the South China Sea. We see this with Taiwan. We see this in other areas. We see this in their attempt to pull world trade off of the dollar standard using more of the RMB. We see this in many different ways. So that part is definitely not going away. Xi Jinping still has some life left in him. He's not as old as Trump. So I think this will persist in one way or another. I don't know how it ends. I don't think anybody knows how it ends. But I think it's either going to blow up or China's going to get what it wants. I don't think it ends totally peacefully.
Very interesting. This seems like a story that's going to be ongoing, at least for a couple more years here.
Yeah, probably a good 10 more years. We'll see. Speaking of stories that probably won't be ongoing for another 10 more years, in the sense that something's going to come to a head sooner or later, the circular AI money is one of them. And I'm going to bring up a graphic as I say this, because Simon, from an outsider's perspective, and I'm someone who knows a little bit, but not a lot about this, we've got companies like OpenAI, and I'll single them out to start with. They're losing increasing amounts of money, but like a college kid with a credit card, they just keep spending huge sums of money they don't have. On one hand, these guys, social science, investing is a social science. And so there's this weird twist where even if OpenAI is, again, they're not the only one, but they're like an anchor player, they can't give companies the cash that they want. They can sort of help them with their halo. Taking this AMD deal as an example, OpenAI says, hey, we can't pay you the cash that you want, but just by announcing this deal, we can send your stock up 29% in a day. That adds almost $80 billion of market cap to your business. Now, again, these were not like explicit contract terms, but this is what happened. These are real economics. So again, I'm going to pull this graphic up for the viewers to see.
Hold on just a moment before we do that, James, if you don't
please.
mind. Let's do a bit of backstory, and then we'll get into the specifics, if you don't mind, because I love the analogy of the college student spending money on the credit card, but even better if you're using the credit card and it's tied to your parents' bank account, where you don't even have to spend your own money. You're spending someone else's money, which is exactly what OpenAI is doing. I think it's brilliant, to be quite honest, that they're going to benefit from all of the computing resources and the infrastructure requirements that are needed to run GPT and all the different iterations that it keeps making of it. But it's getting Google and Amazon and Oracle to pick up the tab for the data centers that are now costing $80 billion a pop to build. And so OpenAI, this is why I consider this a brilliant strategy, because it's letting big tech do what big tech does best, which is spend money on infrastructure, right? This was kind of the cloud computing industry from a decade ago. You know, let Amazon go out there and build it. Let Salesforce go out there and build it. They had a lot of internal computing needs, but it was actually because of economies of scale. It made more sense to build an even bigger data center and then farm out, you know, the things that you didn't need, the computing and the storage that you didn't need, to others, so that they didn't have to go out and spend all the money on their own. There were only a handful of companies that even spend $80 billion on a data center. And so now we're seeing the next iteration of this, James, where it's not just Microsoft using this for its internal needs, for Salesforce using it for internal needs, for Amazon using it for its internal needs. Yes, those are there, but we're starting to get some really large customers that are very ambitious in what they're wanting to do. I mean, Sam Altman is talking about, he wants to spend trillions of dollars to build an artificial general intelligence that's going to require a ton of computing horsepower. And, you know, I have a background in sales, James. And so I know that if I'm talking with one of my larger customers and they say to me, you know, hey, we'd like to increase your sales to us by 10x or more over the next couple of years, you know, but here's the terms we need to do to make it happen. I'll tell you, 0.1 seconds after I hang up the phone with them, you're calling your superior at the company and saying, hey, let's make this deal happen. Let's do this. You know, think about how good this is going to be for us. That's exactly where Nvidia and AMD stand right now. That's exactly where CoreWeave and Oracle stand right now. They're starting to get creative in the deals. We'll talk about the terms of them here in a moment. But in terms of OpenAI and what they're doing out there, they're getting some pretty favorable treatment and some pretty attractive terms, and they're going to benefit from building a lot of the infrastructure that they would have otherwise had to spend their own money on.
Simon, I'm glad you jumped in there. I'm glad, because if you read most of the stuff that's out there or listen to some podcasts I've done when I'm driving, I would say 85% of what's out there is critical about this.
95%, maybe 99%.
Yeah, they say, look back at telecom in the US, look back at the tech bubble. We had some similar circular deals. It was just this, game of, what's the game where musical chairs, where there's not enough to go around, but it's just kind of optically created to look like economic value is transacting when it's really not. I'm glad you jumped in, because you're saying it's not that. You're saying it's more akin, and I don't mean to put words in your mouth, so adjust what I'm saying if you need to, but you seem to be saying it's more akin to just standard finance, in which take a loan, for example. That's just a very simple principle of matching somebody who has money now and wants a payment stream with somebody who needs money now and wants to give a payment stream. So like these two people each have something the other wants. You put them together, value happens. You're saying it's a bit like that, maybe a little more complicated. That some people are, have big infrastructure. Some people need the big infrastructure. Some people have capital. So there's more than two players in this deal. But you're basically saying it's win-win-win.
I'm not sure I would go that far. And I would say it's brilliant from the perspective of OpenAI, who's only got 7,000 employees. It's privately held, and yet it's worth $500 billion. And it's not even spending that much money right now. I mean, James, the company as a whole just said they're going to come out and they're going to do $20 billion in recurring revenue in 2025. And they did less than $4 billion in 2024. So basically a 5x on the top line. But still, that's tiny compared to Google, compared to Amazon, compared to Microsoft. That's a drop in the bucket compared to these companies that are spending $364 billion collectively on CapEx this year, right? So how does OpenAI do that? They're basically come out there and say, hey, we want to build an AGI. We want to give you $180 billion of future revenue, AMD, and a similar number for Nvidia, to use your chips that are cutting edge, highest, highest performance computing that's available out there. Oh, and by the way, we're not going to spend the money to install them. We're going to let Oracle do that. We're going to let CoreWeave do that. They're going to have the CapEx on their balance sheet. We're just going to benefit from all of the revenue that's going to flow in through the models that we're running with OpenAI. I think if I'm looking at that from a individual perspective, that's pretty crafty deal making out there right now. I'm not sure it's good for investors. OpenAI is a privately held company versus these large tech companies that are getting more and more expensive in terms of valuation multiples. I just think that's a clever strategy of getting something for free as they're trying to, make the pie bigger in their own pool.
So, Simon, let me ask you about the risks.
Yes.
And you just alluded that for the individual, maybe a great deal for OpenAI, but for the individual investors in the public securities markets, there seem to be some risks. I know the CoreWeave CEO, what's his name here? I wrote it down. Yeah, it's Michael Intrater. I mean, Jensen Huang of Nvidia, they've been insisting that the circular deal making is good also, kind of like you're saying. But I noticed this Michael Intrater is selling a lot of shares of CoreWeave, not to pick on CoreWeave, but its debt appears to be roughly equivalent, actually larger, excuse me, than its anticipated revenues for the next 5 years. I don't know what the depreciation curves are like on this type of equipment, but I would imagine it's pretty steep.
Yes.
Is there a risk that some people are holding the bag here if things don't blow up in a good way as anticipated?
Good point on the depreciation. Depends who you talk to. I believe they're depreciated for a cutting edge computing chip is 6 years officially. I think it's probably more like 2 years unofficially, just because they keep iterating and making better chips and you can't keep up with their performance. I mean, these things depreciate pretty fast. I think now's the right time to show that graphic, James, just so we can get into this.
Yeah, let me put that back up. This is from Bloomberg. I think it notes on the bottom, but this is, and
but look at these numbers.
It takes you a while to digest all this, right? There's a lot going on here.
There's a lot going on here. Look at the size of the numbers, right? Nvidia is going to invest $100 billion in OpenAI in exchange for future commitments of, I believe that one was 10 gigawatts of Nvidia's chips of deployments. The AMD one, AMD is right there. It says billions of dollars worth of AMD chips. That's 6 gigawatts of AMD's cutting edge processors. By my math, that's worth $180 billion. In terms of if they fully deploy. But this is, first of all, you look at this and the glass half empty perspective on it, the 95% of the perspectives that we've seen in the headlines is saying, oh, there's no way that OpenAI can fund this. They're only making $20 billion this year. How are they possibly going to deploy that many chips? First of all, the deal with AMD is for equity. So AMD is going to give OpenAI equity through penny grants. It's going to cost them absolutely nothing to buy this AMD shares. And then they're going to sell AMD shares to raise capital that they're then going to give to AMD to buy the chips in the future. And what does AMD get from this? Well, it's diluting its shareholders, but man, look at the top line. Look at the earnings per share that's getting out there. I'm like, this is good for the stock in the short term, but then it also makes you scratch your head in the long term of, if I'm an investor, do I want us to give away 10% of the company in exchange for just doing business with the company you probably could have just given better terms to without giving out? I mean, like, some of these deals are a little bit suspect and circular in their terms, James. I think from an investing perspective, I'm less excited about the terms that some of these large tech companies are giving to OpenAI. And it's not just OpenAI, it's also, Anthropic and, others that are also building models that are running off this infrastructure. I'm a little less excited about the big companies that are getting these deals than I am for a company like OpenAI, who's very crafty in how they're framing a lot of this.
That's a good point, Simon. It is a fantastic deal if AGI, if just AI writ large, just goes to the moon. It's probably a fantastic deal for the investment bankers, and it's probably a fantastic win for OpenAI. But they're a private company, and so they have a lot fewer investors. The risk seems to be disproportionately borne by the equity investors in these other companies. It sounds like what you're saying.
And I do want to, maybe if I can close this out with one other comment, because just to say history doesn't repeat itself, but it certainly rhymes. I mean, these are the exact same conversations we were having about Mark Zuckerberg and the metaverse 5 years ago. Do you remember it, James, in 2021 when he came out there and he said he's hiring 10,000 employees in Europe. He's going to spend $10 billion a year on the metaverse. And we're all going to be living in a virtual reality world that, at least in my household, we're still not living in a virtual reality world.
It changed the name of the company.
It changed the whole name of Facebook to Meta. I mean, like, this was such a big deal. And then it kind of, I don't know if you can say it flopped because they're still making money off the Meta, but it certainly is not the same scale like Zuckerberg was having everybody believe it was going to. And yet still, James, even though you look at this and you say from an investment perspective, oh man, it failed. Look at how much money he wasted on the metaverse stuff. Microsoft's stock, excuse me, not Meta's stock has tripled in the 5 years since then. It's now worth $1.8 trillion. So I almost feel like this is just table stakes that you have to go out there and make audacious claims and maybe even spend a couple tens of billions, if not hundreds of billions of dollars these days, just to remain relevant as poker stakes, you know, to get at the table of big tech these days.
It's a big game we're playing. I mean, big stakes. They are big stakes, but hopefully it all works out. But it sounds like, at least in the bull case, we'll look back in 5 years and 7 years and look at all this stuff as rounding error in the big picture for these companies.
We'll see how it plays out. You know, I do think that I have a contrarian opinion to at least most of the perspectives I've had on the deals and the crafting of these relationships. It's very interesting. It's brilliant from AI's perspective.
Well, it is. They're smart guys. Moving on to more something that almost sounds plebeian and passe these days. Tesla, once very hot company, still very hot company, but no longer, I guess, the hottest darling in the market. Tesla delivered just shy of 500,000 vehicles in the third quarter of 2025. I believe that is a record, just barely above their last record. Driven largely by EV tax credits. Speaking of EV taxes, Tesla itself, I believe, sold credits that amounted to 16% of its gross profits in 2024. That is a big number, Simon. I know you are not as like day to day into Tesla as you once were, but broadly speaking, with earnings coming up, are you bullish, bearish, neutral on Tesla?
It's probably going to be good for their upcoming report. That's next Wednesday, I believe, is when they announce, because the tax credit in the U.S. for EVs just expired at the end of September, right? You used to get $7,500, you know, right up front as a tax credit if you bought an EV, Tesla included for those. And so maybe there was a lot of people that wanted to front run that and say, you know, if you're going to buy a Tesla and you're on the fence about it, do it right now before you lose the credit. And it's the same in China too, James. They don't have it the same as a tax credit, but it's a purchase tax exemption, essentially the same thing. That's kind of getting cut in half next year, or at least planned to get cut in half next year in China. So there's a little bit of politics involved that might be pulling some orders in, and that might be why these numbers are looking artificially good, at least for the next quarterly report. But I think that Tesla's got some bigger problems, specifically in China. They're up against some very competent competition, you know, with the Chinese, you know, electric vehicle makers out there. And then also in Europe, they've really kind of, Elon and his participation in politics in the last year or so has really kind of got a negative perception from a lot of Europeans right there. You know, sales in Europe year over year for the first half of 2025 were down almost 50% for Teslas than they were in 2024. So you can just kind of see just kind of the association of a lot of things that Musk is. It's almost portrayed him as a villain for a lot of people in Europe that were really excited about buying his cars.
Oh, well, in the U.S., you see it too on the bumper stickers that, you know, I bought this before Elon went crazy. You know, please don't vandalize my Tesla.
Yeah, right. They were lighting him on fire for a while there, it seemed.
Yeah, it's sad, and it's ironic the role reversal we've had with China on EVs too. For the longest time, China has had the ridiculously protectionist economy, right? Where you got to share technology to come in, or, you know, all the advanced foreign competition, or much of it was kept out for various reasons to help the local industry. BYD, you know, BYD is in Chinese. Weilai, I forgot the English name, but NIO is the English name. These guys are making cars that are a third the price of Tesla, and they're probably 2/3 as good. They're phenomenal values. I believe they're all over Europe. You go to South America, you go to other countries that don't have big auto industries they're trying to protect from Chinese competition. And they're all buying these, or not all, but they're very heavily buying these Chinese EVs. So you wonder, I mean, God bless Tesla, but is it the MySpace of EV, you know, the first mover that laid the groundwork for everybody else, but now there's just better stuff coming down the pike.
James, can you say the neo-Chinese name again? That was kind of neat. How you, what was it? What was it? Wei?
Wei Lai.
Okay, yeah. I'll just say
It's on
Neo because I'm not as
No,
fluent in Mandarin as you are. But I mean, that's a neat one, right? Because it's completely different technology. I mean, instead of supercharging like Teslas and the others are doing, most people don't really like to wait around for 15 or 20 minutes. So they do a battery swap. You drive a Neo in, there's just a mechanical thing that will replace the battery, and it's done in 2 minutes. Kind of like a gas station, but it's even more efficient. It just that's already caught on in China. It's catching on in Europe, and it's a similar premium price point. I mean, you got to watch out for competitors like that.
Yeah, you need high population density for that to work, right? Because you got to have a place to swap your battery out. And the U.S. was really built around the gas-powered automobile. If you look at geographically how much of the country developed, but it certainly could happen. And I mean, they're nice. These cars are nice. It's just amazing. The internal combustion engine car, I think, takes like 5,000, between 3,500 and 6,000 parts, depending on the car, which is a lot of stuff. And the Chinese could never really crack that out. It was just too hard for them to build it well. An EV is like a big golf cart. It's got like 500 and something parts. And you may know a lot more about this than I do, but it's so much easier for other countries to manufacture, and they're doing that.
100%. It's disruptive to the supply chain because stuff that worked for the ICEs does not translate directly over to EVs. You can start seeing building from the ground up and economies of scale starting to kick in.
Totally. Well, shifting gears, but hang on. Oh, I didn't even
unintended pun, James.
I didn't. It was an accidental pun, but I'll take the cheese factor. Staying on cars, we'll shift to stocks that we're watching, and I'll give you a rest, Simon, because you carried the last two stories, and share my stock that I'm watching first. It is called Carvana. CVNA is the ticker, and just like I was concerned about a stock called Opendoor on our last roundtable, I am similarly concerned about this Carvana stock. They basically, you've probably seen them, these glass towers in or near metro areas with these rotating cars. It's like a vending machine for cars. It's a cute thing, but according to many people, it is a gimmick. This is broadly in the same category of Opendoor in the sense of being a left for dead meme stock with a high short interest that has attracted retail investors. Carvana stock was under $4 near the end of 2022, and now it's like 300 and something dollars. So that's 50x gains in 2.5 years. In late 2022, short interest was 71% of float. I mean, that is phenomenal. That's higher than GameStop short interest was during the height of the GameStop meme craze. And that was really what kicked off this whole thing. There is a lot of flack or discussion, I guess, about how it's really making money. They're selling these auto loans. 26% of gross profit came from selling these auto loans. A lot of them risky subprime loans to third parties. They book the gains. They boost earnings. Hindenburg Research says that these loan sale gains were 2.2 times. Hindenburg is a big short seller fund. Net income over a 9-month period. So the question is this really sustainable? The founder pled guilty to felony bank fraud in the early 1990s. It's a cute concept, but it's questionable how long this thing will last. Like, are there real economics here, or is this the meme stock of the month that's driven up by retail investors? So I'm not saying to buy it. I'm not saying to short sell it either, but it is a stock that I would be very cautious of, because just like with Opendoor, I think we're seeing this trend now come back in full force in markets, Simon.
Downshifting, or are we thumbs down on this one, James? That you stay away from Carvana?
We're thumbs down. Okay. I'm putting the parking brake on. I would definitely not buy Carvana
slowly going downhill. Got it. Okay.
All right. So, Simon, do you have a stock, positive or negative or neutral, that has caught your eye in the past few weeks, let's say?
Yeah, let's stick with the international theme. I'll go bullish. I'm positive on MercadoLibre, James. This is a fan favorite. Probably a lot of people listening to this show are familiar with it. It's kind of, one of the largest e-commerce platform in Latin America. And the stock is down about 20% in the last couple of months. There's no financial news that has triggered that, but we did learn two things. One, Marcos Gaporin, who is the company's longstanding co-founder and CEO, will be stepping down from the helm on January 1st, right? MercadoLibre has done very, very well for several decades under his leadership. He's going to remain as the executive chairman, but there's kind of some uncertainty about will that momentum continue after he steps down from CEO on January 1st. So one thing to keep an eye on there. And then the second one is the company is increasingly relying on credit to juice its top line sales. Gross merchandise volume is very, very strong, but a lot of that is due to the financing terms and the credit that it gives vendors to stockpile inventory using MercadoLibre to make them loans for that, or also consumer credit, credit cards even that they're giving for consumers to buy things on the platform. That's good. You want to juice your top line. That's always a good thing for this. But there's also, they've also got nearly 20% of the loans that they're making are past 90 days due and facing delinquency. So that would be unheard of in the United States, America. If 20% of your loans are near delinquency, you would completely write this one off. That's almost par for the course in Latin America. Certainly something to keep an eye on for us as investors, but I think it's probably a buying opportunity right now for a longtime favorite, MercadoLibre.
Yeah, this is like an Amazon or a Walmart of Latin America, basically. And so you are, in broad brushstrokes, sort of playing on the growing population, the growing wealth of Latin America when you buy the stock.
Yep, and they've got plenty of provisions, right? Bad debt provisions, and a lot of the capital they have to hold for the loans that they're making for the capital requirements. I mean, they're doing the protection, so it's not going to blow up. It's just a rising credit risk that I think is scaring away a lot of investors.
Makes sense. It could be a buying opportunity. I know Simon is someone who used to invest a lot internationally myself. Still does. One of my favorite plays is kind of the big responsible company in the risky emerging market, because you often get, you get risk, but you get the growth of that emerging market, which is almost always something you could not get in the US, but then you get the responsibleness, hopefully, of the big responsible company. And this is not a new company. It's been around for a while. It's been a good performing stock for a while. So
100%.
hopefully that plays out for you and for other investors in MercadoLibre. I had the ticker up there earlier, the stock chart as well. MELI, I believe, is the ticker. All right. So I will bring in now our analyst, Xiaoping Wang, to tell us some of the questions we may have gotten throughout this interview. We broadcast on a few different platforms and we do get questions, and I haven't figured out how to get them all into my Riverside FM live feed. So Xiaoping, why don't you ask us what some of the people out there are watching and wondering about?
Okay, we got so many questions. The first one is from Tiffany. It's about the U.S. China. So what's a smart way to hedge against rising geopolitical supply chain risk?
Okay, supply chain risk specifically, huh? Well, there are many different supply chains. The supply chain risk is almost like saying everything risk if you're talking about products, because product trade is the big trade between the U.S. and China. This is going to sound like a cheesy answer, Tiffany, but I say just go outside of the U.S. and China if that's the big risk you're worried about, or just buy stuff in the U.S. that Trump is going to support, whether that's MP Materials, whether that's some of these other rare earth companies, or just any kind of like U.S. Steel. That's another company the U.S. took a strategic investment in. Those are sort of all American supply chain companies. You've got this global deglobalization where both U.S. and China in the sense of semiconductors, U.S. in the sense of manufacturing, are trying to build internally what they were previously buying from the other country. So it might not be ideal for the economy of the U.S. or the economy of China be doing this, right? Trade was trade for a reason. But if you're specifically trying to hedge that risk, that's what I would do.
Thank you so much. So next question is from Greason. More like a chicken and egg question. So if OpenAI, Microsoft, and Anthropic are all locking in exclusive chip deals, can they dictate pricing, or will Nvidia and AMD always going to keep the upper hand? So who's really in control, the buyers or the chip makers?
Yeah, so it's going to be dictated by the end users and how often they're using the way that it works. Speaking of supply chains, are kind of where's the buck flow from? Nvidia is developing the chips that they then sell to the data centers, and then the data centers are selling the capacity on those chips to the users that need them. So it goes from Nvidia to Oracle to OpenAI, if you want to think about it that way. I think that probably the strongest upper hand right now is the companies that are closest to the end user, which would be the OpenAIs. Are you locked in? Do you have 700 million free users like OpenAI does right now? because capacity is going to be capacity, and there's alternatives they can use at different data centers. They can use Oracle, but they could just as easily use Microsoft. You've kind of seen OpenAI and Microsoft going back and forth in the last couple of years in terms of who was going to provide the computing and the storage that was necessary. But OpenAI still has got 700 million users and 6 million that are paying $200 a month, including one James Early for the premium pro
Good
plan.
memory, Simon.
Right, and and they can raise that. They can probably charge you $250, and you'd still do that. And then we haven't even talked about advertising. I mean, 700 million users that are using the free version of GPT aren't paying a cent for it right now. Why are they not starting to put ads on it, just like Google and Facebook have done and built businesses around? I think that OpenAI probably has the most power in that relationship right now, Grayson.
Okay. So we got a real-time follow-up on this question. Does OpenAI getting chip deals from AMD change the AI stock playbook?
Does it change? Excuse me, what was the question?
Does the circular AI chip deals change the whole like AI stock market playbook?
OpenAI getting chip deal from AMD, right? Does that change the stock
this
playbook?
kind of situation, does it change the whole game rule, I guess?
Well, I mean, it's an interesting question. Think about what happened to AMD stock after this announcement, right? It soared. I mean, AMD less than a couple of months ago was trading at $100 a share. I think I haven't even checked in a little while. I think it's $250 a share, $240 a share. It's more than doubled just off of these recent deals, because everyone's excited about them selling more chips. But in my opinion, yes, it has changed because that's not organic demand. This is all on an announcement that hasn't even happened yet, by the way. This is just a tiered commitment agreement that has spent $0 on this contract yet. This is just an agreement of it happening. And if the maximum, if it actually goes into full effect, you could have up to $180 billion of future revenue for AMD. And everyone's very excited about that. I would rather see organic demand where companies and the cloud companies are coming to AMD and saying, we want more chips because we just see organic demand for this, rather than some kind of sweetheart preferential deal out there. I think it does change. It's different today than it was 3 or 6 months ago.
Okay. So next question is about Tesla. It's from Laura. Is Tesla still a growth stock, or is it transitioning into a car stock with tech hype?
James, you want to take this one? Or you want me to take this one?
I'll take it a little bit. Laura seems to, I think I recall that name. I don't know if it's the same Laura who asked the question last time, but thank you, Laura, for being a loyal listener or viewer of the Curia Investment Show. Yeah, I think Tesla is transitioning, but the thing is, you're talking about the car business of Tesla. That itself is transitioning. Tesla's trying to remarket itself as other stuff too, right? AI company, a robotics company. And I can't speak to the chapter and verse of these things, like in terms of the percent of Tesla's revenue. I'm sure it's mostly a car company now. I would say if it doesn't remake itself as a robotics company, which is probably doing partly in fear of the Chinese EV makers, then yeah, it is starting to stabilize. If it can reinvent itself, then guess what? It's a whole new growth stock company again. I would put odds more on the former than on the latter, but that's just me.
Yeah, and I would compliment. I've done, James, you know this already, but I spent a solid 2 months on building a valuation model for Tesla, just because nobody else had done it. I needed to do this, and I came up with
It was a phenomenal model. Let me just say, anyone who was a subscriber to 7 Investing got a lot of benefit. This was like a full-on institutional grade model. Simon really does his homework. That's my plug for you, Simon.
Thank you. And I think I single-handedly supported the coffee industry of Texas for those 2 months because I was massive consumption of caffeine for it. But I came up with a stock price target. I think the last update was 6 months ago, but it was around $720 per share of Tesla, which is much higher than it is today. But 2/3 of it is based upon the robo-taxi network, which is still in its very, very infancy. You know, Tesla has got to go from being a car company, like James, you just said, to being a car company that's also charging you $100 a month for full self-driving capabilities. That's kind of a software company, to being a mobility and transportation company that competes with Uber. I mean, that's where the real future is. It's just gonna take time to do that, not only from a technical perspective, but to convince people to get into a car where there is no driver. Even just the mindset of that is going to take a long time.
Is it a phenomenal mistake, Simon, of Tesla to go with, and we talked about this a little bit, a phenomenal mistake to go with the optical self-driving, the sensors, as opposed to like the LiDAR, that like the Waymo, there was like a Waymo Jaguar or something. It was, I saw the graphic. It's got like a bazillion different sensors, whereas Tesla's just got like a handful of cameras. And that was the cheaper decision years ago. But apparently, it's looking more and more like the worst decision. At least one perspective goes. What do you think about that?
So we didn't talk about that question in advance, James, but I'm actually really glad you asked it, because I did a little bit of prep for the show. That the NHTSA, the National Highway Transportation Safety Association, I believe I have that correct. Might be having one of those words wrong, but they did a look at the full self-driving that Tesla has. It's in 2.9 million vehicles right now, full self-driving mode, not just autopilot, but full self-driving is being used by 3 million cars right now. And they kind of do an incident report on any time there's a crash, something serious happens, or there's an incident or anything like that. And out of these being used in 3 million vehicles, do you know how many incidents that NHTSA is investigating right now?
How many?
58.
Wow.
Which is nothing, right? I mean,
zero, practically. Yeah.
You get 58 citations from people on my street over the weekend in Texas, of human drivers. And it's just amazing how well they have done the engineering on this. I don't think it was a mistake. I just think that they were taking it from ground zero, like Elon loves to do.
And there's headline risk. So if anytime there is an accident, everybody freaks out. But guess what? There are fatalities. There are big accidents every single day with human drivers who are distracted, who are tired, who are on drugs, under the influence of alcohol, all those things that machines don't fall victim to.
Yeah, and that's not fatalities. That's just crashes or an incident or anything like that. It could be a minor thing, but it's still amazing how well they've engineered.
That is impressive. Yep.
Yeah.
So last question is more like general. It's from Lily. If I want to stay invested but reduce risk in this market, what sectors look safest right now?
Ooh, that's a tough question. Well, I would say this. I mean, you could break it out into sectors and say, well, big tech looks very expensive. There's a big exposure to AI, which has been carrying the economy. Therefore, big tech is not safe. And so anything but big tech is safer, like reindustrialization. That's got Trump's essential stamp of approval on that. Small caps are, I don't say safer. They're probably risky, but they're also more vulnerable to, I think, an upswing, especially as rates come down. Small caps relative to large caps have a lot more debt, and a lot more of that debt tends to be at floating interest rate levels relative to fixed rate, which the big companies can negotiate. So it's not directly an answer to the question, Lily's question, but I would say just buy some boring industrial kind of Dow Jones type companies. I'm sure there's some ETFs for that. If you want like pure safety, if you want something that's safer by virtue of not being as exposed to the AI, potential bubble, but with more upside, I would go with small caps.
Yeah, and Lily, I would say my hidden winner from this is consumer discretionary. These are stocks that are being left for dead right now. The Lululemons of the world, the Kavas and the Chipotles and the retailers, the Crocs, Under Armour, Nike. I mean, people are just in the short term not spending a lot of money. The economy's kind of in a funk, and consumer discretionary is, of course, directly exposed to that. But I think that, if we get some kind of normalization back to people going out and spending money, James, I know that you like to say never underestimate the Americans' ability to spend money over long periods of time. I mean, you're getting a really good deal on a lot of those kind of companies if they have, sustainable, long-term advantages over competitors.
America's a nation of spenders. Yep.
Yeah.
Awesome.
Yeah, that's all the questions.
Xiaoping, thank you for rallying those up and presenting them to us. Thanks to those guys who asked all those questions. We really appreciate it. We love your questions, your comments, your likes, your forwards, whatever, your subscriptions, all the support. We love it. It keeps us going. So please keep it coming. We thank you very much for that. Xiaoping Wang, analyst, thanks for your help on this show. Simon Erickson of 7 Investing, thank you so much. As always, it's always a ton of fun to do these with you. And thanks to you guys, as always, for watching us at home.